Okay, everybody, I think I'm going to get started. We are very excited to partner with Aviso Wealth Management and share these highly educational retirement webinars with our Connexus members and our Thrive clients. My name is Leah Pelchinsky. I'm the Manager of Operations for Thrive. I've been in the wealth industry for over 25 years, supporting our advisors in their practice. I moved into a leadership position to lead and build our support team to help grow an efficient business, focusing on member experience. I'm very passionate about helping our members achieve their financial goals. I'll be the facilitator for this presentation, and our presenter today is Doug Carroll. Doug Carroll is the tax and estate specialist for Aviso Wealth, a wealth management partner to our credit unions across Canada. He previously ran an estate planning law practice and was an advanced case consultant with a life insurance insurer and a mutual fund provider. Doug also holds a business degree and a Master of Law specializing in tax and is a qualified certified financial planner and a trust estate practitioner. He's been doing this for 25 plus years, now supporting our financial advisors from written articles to individual case consultations and, of course, webcasts like this today. Doug gets the greatest satisfaction when people say he actually speaks English when he speaks about the law. Just a few housekeeping. We're going to be recording this session, and technology is sometimes not always our friend, so please bear with us. So please join me in welcoming Doug.
Okay, thanks, Leah. I'm going to push up my my PowerPoint here, and as the settings are right now on my screen, as people are joining, there's a beeping sound that's coming up. I'm not sure if it's coming through, but if you hear a beeping, it's coming from me. Yeah, I'm going to move things over a little bit so I can see the main screen, and then we're off to go. So the topic that I'm speaking on here is TFSA and RRSP, and sometimes it's represented as TFSA versus RRSP. That's sometimes how people think about it or might run the phrase, but it's much more about the complement that the two have, TFSA and the RRSP, with one another. And certainly there is a comparison to be made in terms of the tax treatment of the two, which is again complementary. They have both the tax sheltering capability for investment income, but then they're taxed and not taxed, respectively, at different time periods. And so it's good to have a clear understanding of the nature of them so that you can use them in as effective a way as possible. So I'm going to take you through these topics here. I don't think I have any extra slides beyond what it is that I've got up here as the headers, the 10 items that are showing here. If I do, it might be an extra visual that perhaps I've thrown in there that I've forgotten about. And the text that you have coming up on the screen is pretty much what you're looking at here. There won't be much more text, and there'll be a few visuals or graphics that might show the flow of things as a way of representing, as opposed to just text up on the screen. But I won't be testing your eyesight, let's put it that way, to read through the material that we have here. And in terms of that, in terms of the content and reading through the material, we do have some follow-up material that will be shared with you after the program, the presentation program that we're doing here. And the material pretty much runs the same route as the topics as I'm speaking on them here, and it will fill in the blanks. So don't feel that you have to race wildly to write things down. The details will be in those written pieces, the one or more written pieces that we have that cover off the same topics that that you'll see coming up here on screen. As far as any questions, you're welcome to put them into the Q&A function within the program here. And if there's something really critical, I'm sure that Leo will hold me up to address it at that point. But otherwise, for the sake of the flow of things, we will carry things through to the run them through the topic here, and deal with the questions at the end of the presentation material as I'm dealing with it here. So I'll keep an eye on the time. Roughly, I'll go for about 40 minutes or so, which will take us out to a quarter to the hour. and then we'll have some time to deal with any questions that come up if questions come up. So with that, I'll take you to start with the the same, or so with the first of the topics here, and I think that it is important to consider what is the nature of both of the RRSP and the TFSA. What are they for? And the starting point for that is not to say that we're going to swap in and not save by choosing to do one or the other, but rather, what purpose do you have, and for what purpose are you saving? And that'll help inform where your preference might be as between these two places. So knowing why you are saving a particular dollar, or what it's directed towards, not that it has to be very granular about what it's going to be used for, but the general time period and the nature of what it is going to be used for will help you make the decision about where you are going to place that particular dollar of savings. So first off, it is that commitment to have the important behavior of not spending everything that you have that comes in the door, but saving what you have to take care of yourself out there in the future. So living within your means now, saving towards the future, and then living within your means later on. When we did the earlier session on RSPs on their own, that's the common thing that I will say, that when you are taking care of your finances, you are living within your means now, saving towards the future, and then living within your means later on. We're adding the extra element now of talking about not just RSP savings, but where the TFSA adds nuance in how you decide where you're going to save, how you're going to save. So what are you saving for? With this particular instance of setting aside money, will then help you decide between the two. And it's not the only two things that you will save in, the only two vehicles that are available. In fact, one of the things that I'm going to touch on at the very end is the first home savings account, which was made available as of last year. It was introduced a few years ago, I guess, in concept as part of the election campaign a few years ago, and then was introduced in the budget a couple of years ago, and then available now with the structures from the government to be able to be used. And I'm going to give you a funnel side by side of TFSA RRSP and the first home savings account before I'm finished up here. So when do you need the particular money that you are saving? That's going to help you make the decision as to the RSP and the TFSA. RSPs being primarily, or in my opinion, almost entirely, for retirement savings by the phrasing that's used in an RSP, the second R being retirement, registered retirement savings plan. It is possible to use an RSP for access at an earlier stage. It may be that that a decision is made to use it for any purpose whatsoever, drawing it down before retirement years, and one has to be careful about that because it is taxable money when coming back out, and if you take it out early, then you may not have the necessary accumulation of funds to take care of yourself in those years, those retirement years when you are no longer working. So be careful about that. And then there are some set programs that are available with the RSP, the Home Buyers Plan and the Lifelong Learning Plan, which respectively could help you out with buying a home or going and getting some additional education midway through your career, your working years. But primarily, RSP is for retirement. So when you need it in bulk is in those much later years. And the question then is, how does tax then help you reinforce the implications of making early draw, and how does it then affect the draw that you take from the money as the net cash that you're going to come into your hands from using the RSP or TFSA to take money out? And once again, it's not that these are the only two places that you can save money. There's lots of places that you can save, but because these are primary tax sheltered vehicles that are available, that are are defined within the Income Tax Act and are the kinds of things that prominently we discuss, then we do want to be able to look at them side by side. So again, coming back to the RSP to recap on what was discussed last time around, the whole idea is again to set aside money that otherwise could be consumed currently to make sure that you have a reasonable amount that is available to you in your later years, whether that is an RSP which is strictly your own, that has nothing to do with your workplace at all, although in order to have room to put into an RSP, you have to have earned income, working income. It may be that, again, that is your own RSP, which has no connection directly with your workplace, or you might have a group plan at your workplace where contributions are made, and you might have both of those places, and usually people do have both of those possibilities that are available. In terms of the workplace, it could be that you have a registered pension plan, and then you supplement that with contributions into your RSP. If the pension plan does not use up all of your tax sheltering room, then you'd be able to set aside some additional money into RSP. So as I mentioned, the ability to make use of an RSP is based on you having earned income. Earned income is generally working income. There are some odd exceptions to that. Potentially rental income might be able to qualify you for some RSP contribution room, but most of the time we're talking about where you are working. You then are able to make contributions into an RSP based on the room that you collect or accredited, and I'll talk a bit about the numbers that are involved with that shortly. So an RSP is an accumulation vehicle. You can put money into an RSP if you have room, all the way up to December 31st of the year that you turn 71. At that point, you can't put any more money into your RSP. And in fact, there's three possibilities or options you have with the money that exists in your RSP at that time. You can transfer the money from the RSP as an accumulation vehicle over into a registered retirement income fund, a RIF. The RIF, as compared to the RSP, where the RSP has a maximum amount that can go into it, that's your contribution room. A RIF, its feature in terms of the life cycle is that there is a minimum amount that must come out of a RIF on a yearly basis, and it's based on your age. So RSP accumulating upwards with a maximum that can go in. RIF is a declining balance where there is a minimum that must come out each year. You also have the possibility that you can use some of the accumulated money in your RSP to purchase an annuity, which would then pay an annual amount year to year to you on purchasing an annuity. You would purchase that from an insurance company. You give them a lump sum. It doesn't have to be all of your RSP money, but you could decide a certain amount is going to be used as a lump sum to give that to an insurance company. And the contract that you have with them is that they then, or it then, will pay you a yearly amount. Usually it's paid on a monthly basis, but it will then continue on for your life. And the last possibility is that you just liquidate or you cash out some of the money in the RSP. It's generally not a good idea to cash out all of it all at one time, simply because we have a progressive income tax system where, as you have higher levels of income, you pay higher rates of tax as you go up through those higher levels of income. So if you collapsed your lifetime of accumulation in RSP in a single year, you would then push up through those tax brackets and be subject to higher and higher tax rates, and potentially subject to the highest bracket rates around 50%. So usually what people will do is to take RSP and convert most over into a RIF, and possibly some that goes into a registered annuity. The annuity rates, they are based on interest rates, and the use of annuities has perhaps fallen off over the course of quite a number of years when we have had a low interest rate environment. But now that we're seeing interest rates rise, there has been some increasing interest in making use of annuities again, whether that's in this form to use in a registered account, or if you have money that is not registered, you also can purchase annuities that insurance companies make available. So you'll probably hear a little bit more about annuities now that we're into a higher interest rate environment, which is not a nice way of saying we've been seeing inflation for the last few years. That's changed the kind of economic environment that we're operating within. In all cases, whether it is RIF money that eventually comes out into personal hands, annuity payments that are paid from the insurance company, or just a cash out of some amount of the RRSP, all of those amounts are taxable, are brought into your income, and they are fully taxable. And by that, I don't mean that they are taxed at the highest bracket, that there is no special treatment for them, is what I mean. They are taxable, added to your taxable income, as opposed to some types of income that might be earned where you have non-registered money. You get preferred taxation on things like capital gains, where only half is taxable, or Canadian dividends, where you get a procedure where you pay less tax on that than you do on interest payments. But in this case, all amounts, whatever the income source within the registered account might be, all amounts that come out of an RSP, a RIF, or a registered annuity are taxable. So the idea with making use of RSP, and I had this visual that I showed you the last time around for those of you who were able to join. The idea with with an RSP is that you are making use of the ability to put money into an RSP to manage around taxes. So if you look at this as a representation of the number of years you might be working versus the years that you'd be retiring, and that's not to say that this must be the case, but just representative of the amount of years. If each of these boxes on the horizontal plane are about 20 years, then you might work for about 40 years and then be retired for about 20 years. Maybe you have the good fortune that you're going to work for 20 and be retired for 40 on the other side of it. But commonly, people will work for a certain amount of time and then have enough accumulated to take care of those retirement years that tend to be a little bit less time than the working years. And then likewise, just representing the dynamic of it, not of specific dollar amounts, where you have taxes applying in a graduated tax system, progressive tax systems, different terms that apply or are referring to the same thing. Progressive tax rates, graduated brackets, marginal brackets, all three of those terms, what they mean is as you have higher levels of income, you then pay higher rates of tax. So if we can take the dollars that otherwise would be subject to high rate of tax, if you want to look at these boxes as they stack up as low, medium, and high, if we can time shift out the taxes that would apply at the high level, put that money into an RRSP where the income is tax sheltered, whether that income is based on interest payments, dividend payments, or just change increased in value of the holdings, then there's no tax while the money is in that plan. And then when the money comes out in our later years, then the money is drawn out and is not only having had the benefit of had the tax sheltering, but we also have the tax shifting down into lower brackets in most cases. It's not a guarantee that you'll be at a lower bracket, but commonly that's the kind of situation that happens. We tend to be higher income in our working years, and then we go to a lower tax brackets as we go into our later years as we're drawing off of our savings. So that's the RSP and the rationale for making use of the RSP to push forward taxes and push down taxes based on that usual expectation of being a lower bracket in later years, tax-free savings account is relatively newer. It's not entirely the new kid on the block. In fact, it's not the new kid on the block anymore. Now that we have the first home savings account as a pretty significant development in our tax sheltering ability with investment monies. The RRSP was introduced back in 1957, quite a ways back in time. The tax-free savings account was introduced in 2009. So the basic features of it, TFSA is actually a much simpler structure than RRSP. The requirements are that you be at least 18 years of age and be a Canadian resident in order to be entitled to contribution room. You have to have a social insurance number in order to open up an account, because the account has to be reported by the financial institution over to the Canada Revenue Agency. But apart from those three requirements, there's not much more to it that gives you the eligibility to make use of the TFSA. The amount of contribution room is based on an annual figure, and then that annual figure is indexed occasionally, and it's every few years that it's indexed at a $500 amount. So comparatively, an RRSP or RRSP room is stated as a maximum amount per year that you can put into an RRSP. The amount that you personally accumulate is based on your previous year's earned income, but then there's a dollar figure which indexes from year to year. That is the maximum amount that anyone can make use of, and I'll show you that figure just shortly. I don't want to give you numbers just yet until they're actually on screen. Whereas with the tax-free savings account, we have annual room, which is stated as a round figure, and every few years it goes up by about $500. If you don't make use of it, the room that you're entitled to as someone who is 18 years of age or over, then that room carries forward to be used in later years. Unlike RRSPs, where we get that tax deduction when we put money into an RRSP, with TFSA, you don't get a tax deduction on putting the money in. So it's after-tax money that you're starting with. But then when the money is taken out of the TFSA, you don't have any restrictions on what you use it for. Similarly with RRSP sourced money, you don't have to wait until retirement, although, as I say, I would advocate for making sure that you have taken well care of yourself in those later years, that you don't put yourself in peril not to have the money you need in your later years when you're no longer working and won't have a lot of flexibility to earn new income if you don't have your savings readily available to you. You can use the TFSA or the RRSP for any purpose. In either case, you can take money out of the TFSA at any time that you please to have the money out. And one of the really nice things about it is that you recover contribution room on the TFSA. That's not true of RRSPs, but you recover the contribution room in a year that you take money out. You get to put more money back in again. I'll show you that in just a second to give you a little bit of a visual. The big thing, of course, is that when you draw money out of a TFSA, no tax applying on that money coming out into your personal hands. So I said I wanted to give you a little bit of a visual. It is a really little visual here. It's got some pictures, but otherwise it's text about what happens with the recontribution credit. So unlike RRSPs, when you put money into an RRSP and if you take money out, then the room gets used up as you're entitled to it when going in, and the money coming back out has no addition to your ability to make use of the RRSP from that point forward. With the tax-free savings account, what happens is when you pull money out of a TFSA, for every dollar that you take out, you are entitled to put money back in again. In the early years of the TFSA, there was a big concern, and some people perhaps got themselves in a little bit of hot water where they didn't quite understand the mechanics of how this operated, that they may have put money into the TFSA or a TFSA at one financial institution, for example, and may have had money at another one, and they took out from that other institution and moved monies around a fair bit during the course of a given year. The problem is it's like a ratchet. When you put money in, you're using up your room. When you pull money out, yes, you get the credit, but it can't be determined with the Canada Revenue Agency until everything gets reported at year end. So if you take money out during the course of the year, then CRA is not aware of it to show what you're entitled to until you hit the next January the 1st. So you could get yourself into a little bit of a problem. You could potentially over contribute. And certainly if you have made significant use of TFSA and you are right up near your maximum use of your available room, then you might still be in this kind of a risk if you're not careful. For a lot of people who may not have used the TFSA to a significant extent in the early years that the plan was available, they may still have a lot of unused room, and so they don't have as much of a concern about accidentally over contributing. But if you do over contribute, that's very costly, 1% per month on the maximum amount that you have over contributed into the TFSA. That's a pretty hefty expense. If you think about 1% per month, just on a straight arithmetic basis, that's it's at least 12% a year that equates to, and it could be larger than that because it's based on your maximum amount that you have in the TFSA over the course of the month, not on the average of what's in there. So that could be quite problematic. So when you are going to move from one TFSA account to another, there is a form or a process that can be used from one account to another within the same financial institution or from one financial institution to another that keeps that money from exposing you to that potential over contribution. And then, as I said, you get the credit the following January 1st for the monies that you took out during the course of the current year. So that credit, then, if you don't make use of a certain amount of your TFSA room, you have the carry forward of that unused room. There is no time limit when you must recontribute. So though it happens the following January 1st, that doesn't mean that you have to use it in that next year. It just carries out further out in time into the future beyond the point at which you get the credit on the January 1st. But as I said, for the practicality of tracking these things, there has to be a reconciliation at some point in time with the Canada Revenue Agency among all the financial institutions where you might have your money. Now, maybe you have yours in one place only, but it's possible to have the money in the room used in a variety of places. And so in order to have a proper reconciliation of what's available to you, it happens with the Canada Revenue Agency and the reporting of the financial institutions of their record keeping over to CRA as of January the 1st. There's also no limit on the number of withdrawals or contributions. So it's not as if you get room and you get one shot at contributing in. If you don't use all of it, then you can't put any further amount in. I don't know why that was an issue in the early years, that the question came up in a number of places about whether that was something that you were constrained by. It's not. You can make multiple contributions. You can make multiple withdrawals over the course of a year, over the course of time more generally. But again, being careful that you don't over contribute to push past the available contribution room you have in a year and potentially be subject to those pretty hefty penalties. So as I said, I'm going to show you here the numbers that are involved with the RRSP and the TFSA. Again, this is a visual that I used last time around. Different figures though, because I think we were having this conversation, or I was speaking on this back in the towards the end of last year, where I was showing the 2023 figures. Now what I'm showing you is the figures for this current year for 2024. Although in the text down below, we do have the 2023 numbers. So you can see this year and last year. So the general calculation of RRSP room is that you get room allocated to you, available to you, based on your preceding year's earned income. And it's 18% of that figure subject to the prescribed limit, so the regulated limit of how much anyone is entitled to in the current year. That's a dollar figure, which is set by regulation, and it indexes from year to year, as I mentioned, based on the economy, based on inflation that's happening in the economy. I'm not going to try and give you the definition for it. I know roughly where it happens, but it is based on inflation factors that determines how much the room goes up. So the limit for 2024, for this year right now, this is where sometimes confusion comes in, because we haven't, a lot of us will not have, well, we're not entitled to yet file our taxes for last year, but we're in tax filing season until, well, roughly end of April, when the deadline is. And so sometimes there might be some confusion over which numbers we're talking about. So what we're talking about here is the amount of contribution room that you get in 2024 based on last year's earned income, which maxes out at $31,560, as you see inside of the blue box. That level equates to someone who has just over $175,000 of earned income in 2023. So again, it's 23 earned income times 18% will give you that $31,560. And then if you have unused RSP room from any time in the past, then that carries forward, and this new allocation adds to the carry forward room. Importantly, when we're talking about RSPs, we're talking about your pre-tax values of your income. That is the way that we express RSP room. Comparatively, when we're talking about the tax-free savings account, TFSA is after tax. Now, TFSA room in 2024 is $7,000. As I mentioned, there's three components to TFSA. We've got unused room overall that may have existed at the beginning of this year. To that, you'll add this $7,000 of annual room, and it doesn't require that you work. Whereas with the RSP, it does depend on whether you are working as to whether you get room. With a TFSA, age 18, Canadian resident, you are entitled to the room, $7,000 currently in 2024. You add to that, so we have the unused room, we have the new $7,000, and if you made withdrawals in 2023, now the credit comes up as of January 1st, 2024, that gives you some more room based on what you took out last year. So there's that reusability that I was referring to. If you have not made use of the TFSA at all, and if you were at least age 18 in 2009 when the first allocation happened, then you'll have $95,000 of room readily available to you. So almost $100,000 of room. And regardless of whether you have used it or not, that has been the allocation over the course of the time since 2009. So a pretty significant, I know when it came up, when the TFSA came up, there was some people who made the comments that, well, what's the big deal? It's only $5,000. Well, it accumulates over time, and the reusability allows it to have momentum in growing in value. I'm going to show you some figures here of how significant it can be on a single year basis, as well as cumulatively, as I'm showing here, $95,000 in room. Now, just before I move on to that, I want to comment about this figure that we're at right now at $7,000. If you may recall, 2 years ago, in 2022, the amount of room was $6,000. And then last year in 2023, it went up to $6,500. And now this year, it's gone up to $7,000. So 3 years in a row, well, 2 years after where it stood in 2022, we've gone up from 6 to 65, now up to $7,000 of room, which is probably seldom that we're going to see this kind of thing happen. And it's because we've had pretty significant inflation. There's a background reference figure, which is indexed in behind the scene. And when it rounds up the next 500, then the actual room that we get pushes up to that next $500 level. So whereas with the RSP, as you see, it's a fairly ragged figure at $31,560. For the TFSA, it's those round $500 increments that are involved. So we've had a pretty significant jump in the last 2 years, up to 7,000. It will be a few years, not that I'm predicting the economy, but where things stood back in 2022, we were just a tiny bit short of that rounding figure that took it up to 6,500. And because we had really hefty inflation a year and a half ago, we had over 6% the reference rate. That pushed up the reference figure last year just short of where we needed to be to go up to 7,000. And then we had pretty stiff inflation about 6 months ago as it was measured, which then pushes up to that $7,000 figure. So we definitely have benefited to put a positive spin on the inflation as it applies to the availability of TFSA room. I'm sure that's pretty light solace in terms of the cost of groceries and other things that are costing us more, but it is built into the tax system, this indexing of a number of the components of the tax system, and TFSA room and RSP room are two of those things that do increase in value as availability for our savings when you have an inflation rate that then drives these things up a little bit. So one of the things to look at in terms of the TFSA and RSP and trying to equate the two in some way is to say, well, and this is really more of an intellectual exercise as opposed to a practical way to actually measure. But we could consider, if we did not get TFSA room, and comparatively, if the government of the day when the TFSA was introduced had said, we're just going to give people more RSP room, well, that original $5,000 that we were entitled to, which now is 7,000, what would that have been if we were given more RSP room? And it's not a flat figure that we can express for everyone, everywhere. It's something that you'd have to use this formula based on income level. And that's to take the TFSA room, the dollar figure as it stands in any given year, divide it by 1 minus that person's marginal tax rate. So the tax rate that the person would be subject to on the next dollar of income. So here's what that looks like currently in 2024 based on $7,000 of TFSA room. So I've done this based on province and income level, really round income level, obviously, that you can look at this and say, well, and I'll take the first one. If you are someone who is resident in British Columbia and your income is $50,000, then you will have a TFSA room. If you're somebody over the age of 18, you'll have TFSA room of $7,000. Comparatively, if you had been given more RSP room, then how much more RSP room would that mean for you? And at that level of income, then you take 7,000 divided by 1 minus that marginal tax rate, and it gives you about $9,000 that would have been the equivalent in RSP room. And why I like doing this is because we've got RSP, which is pre-tax money. We've got TFSA as after-tax money. It really is the classic fruit bowl of comparing apples and oranges, unless you make that clear distinction between the pre-tax world of RSP and the after-tax world of TFSA. So these aren't real figures that you can then make use of as RSP room instead of TFSA room, but it gives you a sense of the value that might be involved with it. Now, down below, I've got the RSP room that would apply. So 18% of the previous year's earned income. If the person's income was static, same last year as this year at $50,000, then more RSP room at 18% would mean that person gets $9,000 of RSP room, actual RSP room, compared to the figure that we're calculating here of 9,056 for this BC resident at the $50,000 income level. So really, for somebody who's at that level, it's about the same that you would get in either of those two cases. Again, I'm just giving this as a little bit of an intellectual exercise to go through to see how you can compare these two And to say that, or to suggest, as some people do suggest, that TFSA room is not worth the value of it, that the RRSP is much more significant in terms of the value. Well, I don't think anybody's too much complaining about the fact that TFSA is available. It's not like you can't use both of them if you have lots of extra cash and want to make use of them. TFSA has a very significant role to play in people's savings, whether that's short-term or long-term savings, where you want to make use of tax sheltering. So as I said, I don't like the idea of talking about RRSP versus TFSA. I think of it in terms of coordination of the two of them. And there's 3 time periods that we're looking at. When money goes in, or what's the source of it when it goes in, what happens on the inside, and then what happens when it comes back out of the respective plan, RRSP or TFSA. And again, understanding the RRSP when the money comes out would either come out as an RRSP withdrawal or as a registered annuity or as a RIF payment. So we've got pre-tax money, which is another way of expressing that it is tax deductible when you put money into an RRSP. We then get tax deferred growth, and then we have full taxation on the money coming back out again. If we want to look at the TFSA, and I've emphasized it here with the red colors, there is a taxable time with both of these plans. With the RRSP, it happens when the money comes out. With the TFSA, it happens before the money goes in. So you got after-tax money going into a TFSA. You then have tax sheltering, and then you have tax-free withdrawals. Now note, when I'm looking at what's happening on the inside, the growth phase, the accumulation phase of things, the distinction on the phrasing here is that with an RRSP, there is tax deferral because eventually the money will be taxed on coming back out. But because the taxable event for the TFSA was before the money went in, then it is fully tax sheltered in the case of the TFSA. So the question that you may have is to say, well, which one is better, doing the TFSA or the RRSP? And you start on the basis of, what do I expect I'm going to use this particular dollar of savings for, and when am I going to use it? And if it is money that you intend to have that you take in your retirement years, on the assumption that you're going to be in a lower bracket, lower tax bracket in those later years, then your preference would be to go with an RRSP. You're going from the point at which you are high tax rate to lower tax rate, and you will accumulate more of spendable money once you draw that money back out if you put the money into an RRSP. If, on the other hand, with this particular dollar of savings, you expect you're going to use it at a point when you're at a higher tax bracket, then you'll be better off if you put the money into a TFSA. People would say, when would you ever expect that you're going to be in a higher tax bracket? Well, take this example. You've got someone who is going to school, perhaps doing a professional degree, an engineer, let's say. You don't have to be an engineer, but you're going through schooling as a fairly young person in your post-secondary. You're going to start an entry-level job, but having done your best to have a good education and with good prospects of how you're going to apply that education, you're going to start an entry level, but you're going to expect to go at higher levels of income as your career progresses. So you might want to look at least some of your savings, putting into TFSA in those early years, because then when you get into your later years, when you have the higher income as your career gets more established, then you can take money out of the plan in those later years. It will have accumulated more having gone into the TFSA and then coming out at a higher tax bracket going through the TFSA than if you'd put the money into RRSP. Now, I know that's a little bit hard to follow, so I'll try to give you a financial example of how this might work. So side by side, if we have an RRSP and a TFSA and we're at the same tax bracket when the money goes in as comes out, we're in the same net position for spendable cash. So here we have the example. If we've got $100 to go into an RRSP, or $100 that is our working income that we have available, then when we put that money into the RRSP, we have the full $100, which is invested. That's the pre-tax money. we get an investment return of 10%. I'm not saying you actually get this, but it makes my arithmetic visual a little bit easier to follow. So we have $110, and then if we're still at a 40% bracket on having the money come out, then we'll end up with $66 of spendable money. And see, what happens with a tax-free savings account is we have that $100 that existed, except that the money going to a TFSA is after-tax money. So instead of taking our tax deduction with the RSP and having the full $100 in there, instead we got taxed on that $100. We net had $60 to work with because we had to pay the $40 in tax to start with. And then the $60 goes into the same investment choices that we had available to us in the first place. And then we get the 10% return off of that. We end up with $66. And because there's no tax on coming out of a tax-free savings account, we end up with that full $66 of spendable money. So you see, if we're at the same bracket going in and coming out, it doesn't matter which we use, the TFSA or the RSP. But if we're going to be at a lower tax rate coming out, and that's usually what we expect are going to be with RSP savings and just generally working years over to retirement years, then we're better off if we use an RSP. So here, let's say that we were at a 30% tax bracket on coming out of the RSP, then we would end up being taxed at 30% off that $110 or $33. We'd have $77 to spend in that case. On the other hand, if we had decided not to use that RSP available to us, and in fact, we're at a higher tax bracket coming back out again, if we decided that we're going to put that money into a TFSA, then we would have paid tax on the money before going in. So we would only have the $60 to go in on the TFSA. On coming out at a higher tax bracket, we would be worse off for having done that, and so would pay more tax on that money on coming back out of the plan. So our preference with the going into retirement years is to go into the RSP. If we're going to be a higher tax bracket coming back out again, our preference is with the TFSA. So stating it in the reverse in that last example, because that's the part to really might be a challenge to wrap your head around, is if we expect we're going to be at higher brackets. So instead of being at 40, we're going to go up to 50 when this particular bit of savings is coming out, then we will be better off for having used the TFSA, because we will be not taxed at the time we are at a 50% tax bracket. When we pull the money out of the TFSA, we will still have $66, but if that money had been inside of an RSP, being at the 50% bracket, we would only have $55 available to us at that point. So comparatively, what do you use the RSP and the TFSA for? Certainly for retirement, your RSP is your first priority because we expect we're going to be lower bracket. TFSA can be a complement to that, but first priority, RSP for retirement savings. Reusability, the RSP does not have that, and the TFSA, because of the recontribution credit, does allow for us to do that. We can do some splitting with either of the plans. With an RSP, we can put money into a spousal RSP. With a TFSA, the rules do allow for giving money to a spouse that then the spouse can put into his or her own TFSA to make use of TFSA room. We do have interim ability to make use of either of the plans. With the RSP, the home buyer's plan, the formal home buyer's plan, or the lifelong learning plan allows money to be used for those two purposes. The problem or the challenge you have with those is you can withdraw the money for those plans, but you have to put the money back in again. Otherwise, you end up being taxed on that money that you took out if you don't put the money back in again. With the TFSA, there's no restrictions on use of the money, whether it's for home, whether it's for lifelong learning, for a car, or any purpose really. And then in terms of the interactions with borrowing, if you take a loan in order to put into either RSP or TFSA, you're entitled to do that, but you get no deduction for the interest charges that are associated with that. So it's generally not considered to be a great idea to do something like that. If you, on the other hand, were to pledge the value or the contents of your RSP or your TFSA in order to get a loan, you run the risk that the plan will be deregistered. In the case of an RSP, the entire RSP could be taxable at one point in time. And for the TFSA, you might lose all of the tax sheltering both within the plan and when the money comes out of the plan if you were to pledge it for a loan. So there gives you a little bit of a side-by-side comparison of those two. And the last thing that I mentioned was I wanted to give you a little bit of a comparative with the new kid on the block, as I've referred to it, the first home savings account. The first home savings account, when you put money into an FHSA, it's been positioned early on. It was positioned as having the best of both worlds of RSPs and TFSAs. So when you put money into a first home savings account, if you qualify as a first home accumulator, a first home buyer, which basically means that you can't have owned a home this year or in the previous 4 years that you lived in, and you can't have be living in a property that belongs to your spouse. You get to put money into an FHSA, which is deductible to you when the money goes in. The limits on it is, as you see here, $8,000 annually and a $40,000 maximum lifetime that's available to you. And then when the money comes out of the FHSA, you have the other half or the other side of that best of both worlds. So you got the deduction going in like an RSP. And then when money comes out of it, as long as it is used for a first home purchase, then there's no taxation of the money coming out. And in the meanwhile, on the inside, it's been tax sheltered. So there's your best of both worlds that applies. So you have the growth in the value that of what you put in, as well as what you put in, that can come out all without any taxes applying. And then when I've already gone through the RSP or the home buyer's plan and the RSP and the tax-free savings account, comparatively, you can use those programs as well as the first home savings account. There was a concern when the FHSA was announced that, in fact, the rule said you can only use the FHSA or the home buyer's plan for a given home purchase, but the government backed off on that. So you can use the FHSA, the home buyer's plan, and the tax-free savings account. You're not required to, but you can use all of these tax-sheltered programs in order to accumulate money that then you can make use of to purchase a new home or a first home if you fit the definition as a first home buyer. So you got a lot of options that are available to you here. Again, it's not a matter of, from the starting point, RSP versus TFSA. It is RSP complemented by TFSA. And now, for this purpose specifically, for first home buying, we've got a full complement of RSP, TFSA, and the FHSA. All right, Leah, I'm going to let you come back in here and let me know what questions we might have had come up while I've been speaking here, and I will let you take it there.
Thanks, Doug. I just want to take a few minutes to thank Doug for hosting and educating us about TFSAs and RSPs. Really appreciate the time, Doug, as it becomes very complex in all of the different situations and everybody's unique situations as to what would be the best choice for them. And I really want to take the time to thank our guests today for joining us for this webinar. So I'm going to open it up for Q&As if you want to put those in the chat. We don't have anything yet, but I do want to just also remind you of a couple of things. One, you're going to be receiving an email from me, which is going to be having a survey. And we really appreciate the feedback about the event so that we know what we're doing well in these webinars, what you like hearing about in the webinars, and to be able to keep on hosting these type of things. You're also going to receive, if you've given us consent when you registered, an email from an advisor with some handouts about the information that was shared today. And if you don't give us consent and you would like to still have these handouts, please just put it in the chat and we would absolutely add you to the list. If you have any questions or would like to start your next steps in planning your retirement, you can reach out to a financial advisor or contact our member contact center or Thrive Wealth Management. And as you can see on the slide, you would see our phone numbers and email address to get us to get more information. So I don't see anything in the chat, Doug, but I do have a question. Would you say, is it better to pay off your mortgage or to put money into an RSP or TFSA today?
I think that quite often these are set like I was saying about the TFSA versus RSP, that it's a black and white distinction of you can do one or the other, and quite often we do have debates about taking one side or the other. In terms of the application of money that you have available, whether it is towards paying down a significant debt, a mortgage debt, versus putting into one of these two plans. Again, I don't think that it's that they have to be mutually exclusive of one another. It does depend on what your expectations are of what the flows that you will have of income into the future, and the costs that you have of your existing arrangements. So, in terms of the mortgage costs that you have, you know how much interest charges you are paying on that. So that's relatively fixed in terms of your comparison versus what you expect you're going to earn on either the TFSA or the RSP as an accumulation. I think that for me personally, I lean towards, and I'm not saying absolutely that every dollar would go towards the paying down of the mortgage, but I lean towards skewing a larger proportion on that known debt, that known cost, because it's costly. And with a home mortgage, there is no deduction for the amounts that you have there. So the comparison of having a non-deductible interest charge versus having a tax sheltered growth amount that's available to you, you could look at those numbers and say, well, I know, quote, know that I'm going to be able to get 5% or 6% on my returns on my investment, whether TFSA or RSP. But you don't really know that. You hope and you expect that, whereas you know exactly what the cost is for your mortgage. So up to you where you want to lean towards. If you are able to knock down your mortgage as a little bit quicker in time, and by quicker, I don't mean in the matter of months necessarily, but knocking a few years off, then once you get past that, you will be able to allocate more money towards those other savings. So it does depend on what your inclination is towards the continuing debt of the mortgage versus the growth of the value. I think you do a little bit of both, but personally, I would and I did actually knock down the mortgage first, and then I have that much more, or had much more, to be able to then put into savings thereafter. It's a personal decision, but it should be informed by the actual numbers that are in front of you.
Great, thanks. And I think then the other question that we get quite often is, what's the difference between a beneficiary and a successor holder? And then is that for both your RSP and your TFSA?
Right. So you can name a beneficiary off of your RSP or your TFSA. And what happens then is the contents or the value of the plan goes to the person who is named as the beneficiary. You can also, with a tax-free savings account, you can use what's called a successor holder. And the difference is that only a spouse can be named as a successor holder. It may be that that's the person who you name as beneficiary anyway. The difference, though, on the TFSA between the beneficiary and the successor holder structure of things is that the value of the plan of the TFSA goes to the named beneficiary, even if it's your spouse, if it is a beneficiary designation. Under a successor holder, the existing plan continues on, and the spouse, as a successor holder, is swapped in as the new annuitant on the plan. With a spouse who is named as either a beneficiary or as a successor holder, that adds to the tax sheltering capability of that surviving spouse, whether you go the beneficiary or the successor holder route. So it's the same tax benefit you get of larger tax sheltering room for that spouse. The difference really is just whether you have continuity of the existing contract under the successor holder, or pay out of the cash to the receiving spouse, who then makes a decision what to do with that cash having received it, whether to put it into his or her own TFSA or to put it into some other purpose. And if the person is named as successor holder, the spouse, then he or she could just withdraw the money after the death of the first spouse as well. So again, you've got the same options of where to put the money when you have the successor holder or the beneficiary designation.
Thanks for the explanation. You know what, Doug, I don't see any other questions in the chat. With that, it's 1 o'clock, and just wanted to thank you again for joining us for this webinar, and have a great day, everybody.
Thank you.